Silver doesn't trend, it ambushes. 4 rallies across 5 decades, each one brutal, each one fast. But here's what the business community missed. Only 3 of them rewired the entire system. 1980, regulatory control was weaponized. 2011, Wall Street financialized physical metal. In 2025, something broke that no central bank can fix. The third transformation isn't about price, it's about supply reality meeting irreversible demand. And if you're running a metals-intensive business, this isn't a rally. This is a warning you cannot afford to ignore. Welcome to Financial Crisis Explained. If you've been watching markets long enough to remember when silver actually backed currency, then you understand why this analysis matters. Do us a favor, would you? Hit that subscribe button, not for algorithms, but because these economic briefings are built for people who make real decisions with real capital. And drop a comment. Tell us where you're watching from today. London? Singapore? New York? Let's see who's paying attention to what the silver market is actually saying. Now, let's begin with part 1. Most commodities behave predictably. Copper trends with construction cycles. Oil responds to geopolitical supply shocks. Gold moves when confidence in currency systems fractures. But silver? Silver operates under a different set of rules entirely. It sits dormant for years. Price action flat enough to convince traders it's dead. And then it detonates with a velocity that catches institutional desks, central banks, and industrial buyers completely off guard. This isn't volatility in the traditional sense. This is structural ambush behavior. And understanding why it happens separates those who survive silver rallies from those who get destroyed by them. The root cause is simple but lethal. Silver is the only major commodity that exists in 2 completely different economic universes simultaneously. On one side, it's a monetary asset, a store of value, a hedge against currency debasement, a physical claim on wealth when paper systems fail. Throughout history, silver has functioned as money longer than any fiat currency currently in circulation. When confidence in central banking erodes, when inflation becomes undeniable, when geopolitical stability cracks, silver trades like insurance. But on the other side, silver is an irreplaceable industrial metal. It's in solar panels, electric vehicles, semiconductors, medical equipment, 5G infrastructure, water purification systems. Its conductivity is unmatched. Its antibacterial properties are irreplaceable, and its role in the energy transition is non-negotiable. When industrial demand surges, when manufacturing accelerates, when technology requires scale, silver trades like a critical input with inelastic supply. Here's where the danger lives. These 2 demand profiles don't just coexist, they conflict. Industrial users need stable, predictable pricing to manage margins and plan capital allocation. Monetary buyers need accumulation during uncertainty, which creates exactly the kind of instability industrial users cannot tolerate. And the market? The market has no mechanism to reconcile these forces smoothly. So instead of trending gradually like other commodities, silver compresses. It absorbs pressure from both sides, monetary fear and industrial need, until the spring releases. And when it does, the move isn't measured in weeks, it's measured in days. This is why traditional commodity analysis fails with silver. Supply-demand models that work for copper or aluminum assume rational, gradual price discovery. They assume that rising prices will incentivize new supply, that falling prices will curtail demand, that markets clear efficiently over time, but silver doesn't clear efficiently. Because half the buyers aren't looking at fundamentals. They're looking at systemic risk. And systemic risk doesn't respond to marginal cost curves or production forecasts. It responds to fear, to policy failures, to the moment when confidence breaks and physical assets become the only assets that matter. Business leaders miss this repeatedly. CFOs managing procurement for electronics manufacturing see silver as a line item, a cost input to be hedged with futures contracts and supplier agreements. They optimize for price stability. They plan around historical volatility ranges. They assume the market will remain liquid when they need to scale. And then a rally hits. Not a gradual climb they can adjust to, but an explosion that locks them out of physical supply, forces them into spot market panic buying, and destroys their margin assumptions for the next 18 months. The institutional memory in corporate America is short. Every rally produces the same headlines. Silver shortage fears, grip manufacturers, industrial buyers scramble for supply, hedge strategies fail amid unprecedented volatility, and every time the rally ends, the lesson gets forgotten. Until the next ambush. So the question that matters isn't whether silver will rally again. It will. The question is whether the next rally will be fireworks or a fundamental transformation. Because across 5 decades, there have been 4 rallies that business leaders still reference. 1979 to 1980, a 543% surge that ended in regulatory intervention. 2009 to 2011, a 293% climb that financialized the entire market structure. 2020. A brief but violent dislocation that exposed the fragility of paper pricing mechanisms. And 2025 into 2026, a 320% explosion that is still being analyzed in real time. But here's what the data reveals. Only 3 of these rallies actually changed the system. Only 3 created permanent structural shifts that altered how silver is regulated, how it's traded, and how physical supply interacts with price discovery. 2 of them changed the rules. 1 of them changed reality itself. And if you're running a business with exposure to metals, intensive supply chains, understanding which is which isn't academic, it's survival. September 1979, silver is trading at $7.69 per ounce. Inflation is running at 13% annually. The Iranian Revolution has just choked global oil supply, and the United States dollar, the world's reserve currency, is collapsing in real time against hard assets. In the middle of this chaos, 2 brothers from Texas are quietly accumulating the largest private silver position in modern history. Nelson Bunker Hunt and William Herbert Hunt, heirs to an oil fortune. But more importantly, students of monetary history who understood something most investors didn't. Paper currency always dies. Physical assets always survive. The conventional narrative calls it a corner, an attempt to manipulate the silver market through brute force accumulation, to squeeze short sellers, to artificially inflate prices for speculative profit. But that analysis misses the deeper truth. The Hunt brothers weren't gambling. They were voting. Voting against the credibility of the Federal Reserve, voting against the sustainability of fiat monetary policy, voting with physical metal in a world where paper promises were becoming worthless. And they weren't alone. Across the Middle East, oil-rich nations were converting petrodollars into tangible assets. Across Europe, institutional investors were fleeing sovereign debt. Across America, ordinary citizens were lining up outside coin dealers to exchange currency for silver rounds. The Hunt accumulation wasn't creating the panic. It was amplifying a systemic breakdown already in motion. By December 1979, silver crosses $15. By January 1980, it breaches $30. And on January 18, 1980, silver hits $49.45 per ounce, a 543% surge in 16 months. Industrial users are paralyzed. Manufacturers are halting production lines because raw material costs have exploded overnight. Jewelry fabricators are melting inventory just to stay solvent. And the futures exchanges, they're watching margin requirements get weaponized in real time. Here's where the first transformation begins. On January 7th, 1980, the COMEX exchange changes the rules mid-game. New margin requirements, new position limits, and a policy shift that would echo through commodity markets for the next 40 years. They moved to liquidation-only trading for silver futures. No new long positions allowed, only exits. It wasn't a market correction. It was a policy intervention designed to break the rally by force. And it worked. By March 27th, 1980, Silver Thursday, the Hunt brothers' position collapses. Silver crashes from the high 40s back to $10 within weeks. Billions in paper wealth evaporated. The corner broken. The speculative fever ended. But here's what didn't end. The regulatory architecture that was built during that crisis. Before 1980, commodity markets operated with relatively loose position limits. Large players could accumulate massive positions with minimal oversight. Physical delivery was a legitimate strategy for those who wanted to own the underlying asset. After 1980, everything changed. Position limits became standardized. Margin requirements became a tool of market control. And exchanges gained the authority to alter contract terms retroactively when systemic risk appeared. The Hunt brothers didn't just lose a trade, they created a precedent that said, if you accumulate too much physical metal, policy will intervene to stop you. This was transformation number 1. Not a price move, not a temporary supply shock, but a permanent restructuring of how commodity markets could be controlled. For the next 4 decades, every major silver rally would be analyzed through this lens. Could the exchange step in? Could margin requirements be raised? Could position limits contain the move before it destabilized the broader financial system? The lesson institutional memory absorbed wasn't about supply and demand. It was about control. And that lesson shaped every strategy that followed. Hedge funds stopped accumulating physical. They shifted to paper derivatives, where positions could be unwound without triggering delivery squeezes. Institutional buyers learned to avoid concentrated positions that might invite regulatory scrutiny. And central banks, they learned that commodity markets could be managed if intervention came early enough and with enough force. But there's a darker implication buried in this transformation. The 1980 intervention worked because the rally was driven by concentrated speculation. Remove the Hunt brothers, raise margins, and the buying pressure collapses. But what happens when the rally isn't driven by 2 billionaires? What happens when it's driven by structural supply deficits, irreversible industrial demand, and monetary debasement that no policy tool can reverse? That's the question the next two transformations would answer. And the answer? It's why 2025 into 2026 isn't just another rally. It's the moment when regulatory control met physical reality. And reality won. September 15th, 2008. Lehman Brothers collapses. Within 72 hours, the global financial system is on life support. Bear Stearns, gone. Merrill Lynch, absorbed in a forced sale. AIG, bailed out with $85 billion of taxpayer money. And the Federal Reserve? They're about to do something unprecedented in monetary history. They're about to print money on a scale that makes every previous crisis response look like a rounding error. By early 2009, quantitative easing is no longer theory, it's policy. The Fed's balance sheet explodes from $900 billion to over $2 trillion in months. The European Central Bank follows. The Bank of England follows. The Bank of Japan, already a decade into their own monetary experiment, doubles down, and quietly, in the wreckage of collapsed credit markets and shattered confidence, silver begins moving, not because of two Texas billionaires this time, not because of a concentrated position that regulators could isolate and destroy, but because millions of investors across the world are watching central banks commit monetary suicide in slow motion, and they're drawing the same conclusion the Hunt brothers drew 30 years earlier. Paper promises are becoming worthless. Physical assets are the only rational hedge. December 2009, silver is trading at $12.59 per ounce, still recovering from the panic liquidation of late 2008 when everything, even safe havens, sold off in a forced deleveraging event. But something different is happening this time. Retail investors aren't waiting for institutions. They're buying directly. Coin dealers are reporting unprecedented demand. Online bullion platforms are seeing order volumes that crash their websites. And in November 2009, something genuinely transformative launches. The iShares Silver Trust, ticker symbol SLV, an exchange-traded fund backed by physical silver stored in vaults. For the first time in history, retail investors can buy exposure to physical silver with the liquidity of a stock. No storage concerns, no dealer premiums, no minimum order sizes. Just click and own silver. The impact is immediate. Within months, SLV is holding hundreds of millions of ounces. Within a year, it becomes one of the largest holders of physical silver in the world. And the demand? It's not coming from hedge funds running macro trades. It's coming from teachers, engineers, small business owners, retirees, people who watched their 401ks get cut in half, people who heard too big to fail and understood what it really meant, people who no longer trusted that governments could manage currency without destroying its value. This wasn't speculation. This was a vote of no confidence in the entire post-2008 policy framework. By April 2011, silver hits $49.47 per ounce, a 293% rally from the 2009 lows, just shy of the 1980 peak. And for a moment, it looks like history might repeat exactly. But this time, there's no single villain to blame, no Hunt brothers to prosecute, no concentrated position to unwind, just millions of distributed buyers holding physical metal through a financial instrument that didn't exist in 1980. And here's the critical difference. When silver crashed in 1980, the infrastructure disappeared with it. The speculative fever broke, the players exited, and the market returned to its pre-rally structure. But after 2011, the infrastructure remained. SLV still exists. It still holds over 500 million ounces. The vaulting capacity built to support ETF demand, still operational. The dealer networks that expanded to meet retail buying, still in business. The institutional acceptance of precious metals as a legitimate portfolio allocation, permanently established. Even after silver retreated from the 2011 highs, even after the rally ended and prices consolidated for years, the financial architecture remained intact. This was transformation number 2. Not regulatory control like 1980, but financialization. The conversion of a physical commodity into a tradable financial asset with mainstream liquidity. Before 2011, owning silver meant storing metal. It meant dealer spreads, vault fees, insurance costs, illiquidity. It was a niche position for hardcore gold bugs and industrial users. After 2011, silver became a checkbox in asset allocation models. Pension funds could hold it. Wealth managers could recommend it. Retail platforms could offer it alongside stocks and bonds. The barrier to entry collapsed, and the participant base expanded permanently. But here's what most analysts missed. Financialization didn't just increase access. It fundamentally altered the relationship between paper price and physical reality. In 1980, if you owned silver futures, you could theoretically take delivery. The paper contract was a claim on physical metal, but by 2011, the derivatives market had grown so large relative to physical supply that the connection between paper and metal had become abstract. SLV could issue new shares, but only if authorized participants could source physical silver to back them. Futures contracts could trade in unlimited volume, but physical delivery remained constrained by actual production and available inventory. And for years, this worked fine, because industrial demand was stable, because investment demand was episodic, because supply could stretch to meet both. But what happens when industrial demand becomes structural instead of cyclical? What happens when energy transition technologies require silver at a scale that mining supply cannot sustainably deliver? What happens when the paper market writes promises that physical reality cannot honor? That's the question. Transformation number 2 created but couldn't answer. The 2009 to 2011 rally proved that silver could be financialized, that it could be packaged, traded, and held like any other asset class. But it didn't prove that financialization could survive a genuine supply deficit. It didn't prove that paper derivatives could maintain price discovery when physical metal became scarce. And it certainly did not prove that ETF structures could function in a world where authorized participants couldn't source the underlying asset. The infrastructure built between 2009 and 2011 made silver accessible, but it also made it vulnerable. Vulnerable to the exact scenario that regulatory control in 1980 was designed to prevent: a rally driven not by speculation, but by mathematics, by supply that cannot expand fast enough, and demand that cannot be policy managed away. That scenario didn't exist in 2011, but by 2020, the first cracks started appearing, and by 2025, the third transformation wasn't just beginning, it was rewriting every assumption the previous two had established. March 18th, 2020, the world is in lockdown. COVID-19 has shut down economies across every continent, supply chains are severed, manufacturing is halted, and financial markets are experiencing liquidation on a scale not seen since 2008. Silver crashes from over $18 in February down to $11.77 by mid-March, a collapse that makes no fundamental sense. Industrial demand is falling, yes, but monetary risk is exploding. Central banks are launching stimulus programs that make 2008 look restrained. The Fed cuts rates to zero, again. Unlimited quantitative easing, again. Trillions in fiscal spending authorized in days. Every condition that drove the 2009 to 2011 rally is present, amplified, and happening faster. So why is silver collapsing? Because in a margin call crisis, everything sells. Hedge funds need cash. They dump gold and silver to meet redemptions. Institutions need liquidity. They sell whatever has a bid. Even assets that should be rising get sacrificed in forced liquidation events. But here's what happened next. And this is where the cracks in the system started showing. Physical silver disappeared. Not in price terms. Price was still suppressed. But in actual metal. Coin dealers ran out of inventory within days. Mints couldn't produce fast enough to meet demand. Refineries were operating at reduced capacity due to lockdowns. And authorized participants backing SLV, they couldn't source enough physical silver to create new shares even as investor demand surged. For the first time since ETFs launched, the paper market and the physical market completely disconnected. You could buy SLV shares at $14 while physical silver coins were selling for $25 on the retail market. A 78% premium, not because of shipping delays, not because of dealer markups, but because physical metal had become genuinely scarce while paper contracts remained abundant. The 2011 infrastructure, the ETFs, the financialization, the liquidity, all of it assumed that physical supply would always be available to back the paper. And in March 2020, that assumption broke. It broke quietly. It broke temporarily. But it broke in a way that sent a signal to anyone paying attention. Paper silver only works when physical silver exists to validate it. By August 2020, silver had recovered to $29.26. A strong rally, but not transformative. The dislocation healed. Authorized participants sourced metal, ETF creation resumed, and the system stabilized. For most analysts, the March 2020 event was an anomaly, a temporary stress fracture caused by pandemic-related logistics disruptions. Nothing structural, nothing permanent. But they were wrong, because what happened in 2020 was a warning shot, a preview of what happens when industrial demand, investment demand, and supply constraints all converge at the same time. And by 2025, that convergence wasn't theoretical anymore. It was unavoidable. Late 2024 into early 2025, silver is trading around $29. Inflation has remained persistent despite central bank rate hikes. Geopolitical instability is intensifying. US-China, tensions over Taiwan, Middle East conflicts, energy supply disruptions. But the real driver isn't monetary, it's industrial. Solar panel installations are accelerating globally as nations race to meet carbon reduction commitments. Electric vehicle production is scaling faster than anyone forecasted. Data centers powering AI infrastructure are consuming silver in quantities that didn't exist 5 years ago. 5G network buildouts, semiconductor demand, medical device manufacturing. Every major technology trend of the 2020s requires silver, and not in cyclical amounts, in structural, non-negotiable, irreversible amounts. Here's the mathematical problem. Global silver mine production is roughly 800 million ounces per year. It's been relatively flat for over a decade. Opening new mines takes 7 to 10 years from discovery to production. Recycling provides some supply, but not enough to offset demand growth. And industrial demand alone is now consuming over 600 million ounces annually. That leaves 200 million ounces for investment demand, jewelry, coinage, and everything else. But in 2025, investment demand isn't 200 million ounces. It's multiples of that. Because the same monetary conditions that drove 2009-2011 are back, except worse. Debt levels higher, currency debasement more extreme, trust in central banking more fractured. The math doesn't work. You cannot have industrial demand consuming 75% of supply. While investment demand surges to levels last seen in 2011 and expect price to remain stable, something has to give. And in early 2025, it gives. Silver moves from $29 to $40 by spring, to $70 by summer, to $100 by early 2026. And by mid-2026, it touches $121.67, a 320% rally, the largest nominal gain in silver's history. But here's what makes this different from every previous rally. This time, regulatory intervention doesn't work. In 1980, they raised margins and broke the Hunt brothers. Effective, because the demand was speculative and concentrated. In 2011, they could have intervened, but didn't need to. The rally exhausted itself as investment demand cooled and industrial consumption remained manageable. But in 2025, 2026, you can raise margin requirements all you want. It doesn't matter. Because the buying isn't coming from leveraged speculators. It's coming from solar manufacturers who need physical metal to fulfill contracted projects. It's coming from EV producers who cannot build batteries without silver. It's coming from semiconductor fabs that have no substitute material. And it is coming from sovereign wealth funds and central banks who are watching the dollar-denominated system fracture in real time. This is transformation number 3. And it's not about regulation like 1980. It's not about financialization like 2011. It's about physical supply dominance. The moment when paper markets lose the ability to suppress price because physical demand cannot be denied. For 40 years, since the Hunt brothers, the silver market operated under an implicit assumption. The assumption that policy tools, margin requirements, position limits, exchange interventions could contain any rally before it destabilized the system. And for 40 years, that assumption held. Because every rally was driven by forces that could be interrupted. Speculation can be margin called out of existence. Investment demand can be discouraged through policy signaling. But industrial demand driven by legislated carbon reduction targets, by technological infrastructure that cannot function without specific materials, by energy transition commitments that entire economies are staked on, that demand doesn't respond to margin hikes. It doesn't care about COMEX rule changes. It needs metal or production stops. And that's the strategic warning embedded in this rally. Silver isn't spiking because traders are bullish. It's spiking because physical reality has asserted dominance over financial engineering. The 3 transformations now complete. 1980 taught the market that regulation could control speculative excess. 2011 taught the market that financialization could democratize access and create liquidity. 2025-2026 is teaching the market that neither regulation nor financialization can override supply-demand mathematics when demand becomes structurally inelastic. For business leaders, this has immediate implications. If you're managing procurement for electronics manufacturing, your input costs are no longer predictable. If you're running a solar installation company, your margin assumptions are obsolete. If you're planning capital allocation in any metals-intensive industry, the models you used for the last decade are now irrelevant, because the 2025-2026 rally isn't a temporary spike that will revert to mean. It's a repricing event, a recognition that silver supply cannot scale to meet the demand profile of the next 20 years. And once that recognition becomes consensus, once industrial users start stockpiling instead of just-in-time ordering, once investment buyers understand that physical scarcity is real and not just a narrative, the price discovery mechanism doesn't stabilize. It breaks entirely. The Hunt brothers tried to corner silver with capital. They failed because policy intervened. The 2009-2011 buyers tried to own silver through financial instruments. They succeeded in building infrastructure, but the rally ended when investment demand cooled. The 2025-2026 buyers aren't trying to corner anything. They're just trying to secure supply for operations that cannot function without it. And there isn't enough supply to go around. That's not speculation, that's mathematics. And mathematics doesn't negotiate with central banks. 3 rallies, 3 transformations, regulatory control in 1980, financial infrastructure in 2011, physical supply dominance in 2025, 2026. The first 2 changed how silver trades. The third is changing what silver means. It's no longer just a precious metal or an industrial input. It's a tangible measure of whether the global economy can deliver the energy transition it has legislated into existence, without triggering supply crises and the materials required to build it. And right now, the answer is no. Silver's explosion isn't a warning about silver. It's a warning about every critical material embedded in the infrastructure of the next decade. Lithium, cobalt, rare earths, copper. The same supply-demand imbalance exists across the entire commodity complex. Silver is just moving first, because silver always does. It doesn't trend, it ambushes. And this ambush, it's revealing a structural problem that no amount of financial engineering can solve. Physical reality has limits, and we've just hit them.